Hello everyone. We had done with the classification of financial instruments as the financial assets, financial liabilities, and the equities. In today's class, we are going for the sub-classification and we will discuss about the sub-classification of financial assets. Here is a embedded derivatives. It is a special type of the derivatives. Okay. So it is the component of the hybrid contract. You are already studied about the hybrid cars, hybrid vehicles and all. So this is the same type. Here, in one particular contract, there are two sub-contracts which are different. Let's understand this with the example. A company with dollar as its a functional currency buys a raw material for the use in the production from UK company that has pound as its a functional currency. So there are two companies, one has the dollar as a functional currency, another has the pound sterling as its a functional currency. But the transaction is denominated in euro. So in this case, there are two contracts. One is contract to buy and sell the goods, and another one is the contract to movement on the dollar to euro and pound to euro. So because the transaction is denominated in euro here, one company should convert the euro into the dollars and another company should convert the euro into the pounds. Correct? There are two types of the contracts and this is a embedded derivative. Why it is a derivative? Because the price of the contract will change with the underlying asset. What is the underlying asset here? The exchange rate of the euro. Fine. So likewise, there are many examples. I have considered only two examples. Leases, which includes the rental based on the sales. Here, lease is the post contract, whereas the contingent rent, which is changing, is the embedded derivatives. In the construction contract, which is priced in the foreign currency, then the construction contract, what is there? That is a host contract, whereas the exchange rate in the foreign market is the contingent value. That's why it is a embedded derivatives. So how to treat these embedded derivatives? If host contracts comes under within the standard, that is the accounting standards which we are already studying. So if it comes under within the standard, then we should treat it as the whole one contract. Host is an asset within the scope of the standard. An entity shall apply the requirements of the classifications and measurement rules to the entire hybrid contract. There is no need of sub-classification as a host contract and embedded derivatives. If the host contract not comes under the scope of the standard, then host is not an asset. Okay, host contract is not the asset within the scope of the standard, and embedded derivatives shall be separated from the host. Embedded derivatives contract should be separated. It should be accounted for the derivatives under the standard if and only if these four conditions are fulfilled. So I'm just going to read out these four conditions and in simple I'm going to explain in the next slide. If the economic character and the risk are not closely related to the host contract, embedded derivatives would meet the definition. It should meet the definition only, then only we can treat it as a derivatives. Hybrid contract is not measured at a fair value. Changes in the fair value is recognized in profit and loss account, and embedded derivatives are need to be separated but unable to measure. If we are unable to find out the value of the separated or the embedded derivatives, then we need to treat it as fair value through profit and loss account. In short, we have mentioned it as FVTPL. Right. So the same four conditions are mentioned here itself. If the contract is carried at fair value through profit and loss account, if we are treating the contract in the profit and loss account, then we need not to segregate the contract as a host contract and the embedded derivatives. If it is not treated in the profit and loss account, then we should go further. Will the contract give rise to a freestanding derivatives if separated? So if the contract is separated as the embedded derivatives and the host contract, then will it fulfill the complete definition of the derivatives? If it fulfills the complete definition of the derivatives, we need to go further. If not, there is no need of segregating the contract as the host contract and embedded derivatives. If it fulfills the derivative condition, we need to check is the derivatives are closely related to the host contract. If it is closely related, then don't go for the classification of a host contract and embedded derivatives. If no, only split the contract and account for the embedded derivatives separately. So this is what the conditions. Here is the classification of the financial assets under Indian Accounting Standard 109. The classification is based on two criteria. There are two criteria. One is business model. So it is what type of the business the company is doing. Okay. And on the basis of the business model, if you are invested, you have three options. And these decisions are based on your business model. Fine. So if you are invested 1 lakh in securities, I'm not going to mention the security, any of the security. You can receive the return and wait till the redemption. If the security is redeemable, you can receive the return. It's nothing but cash flow, and you can wait till the redemption. Then you have the option to sell that particular security when the market value is more, and when you are selling, you can sell before the return and after the return. Very importantly, after the return selling takes more important place in this particular treatment, and sell the part when the value is more. You can sell your security partly when the value is more and hold the remaining and receive the return. So this is also one of the option which you have, and this is directly related to the business model, which decision you are going to take. Okay, or else I can say investment objective. And the second criteria is contractual cash flow characteristics. To do the above three types, these three options need to determine a suitable type of the security, because contractual cash flow characteristics may be different for different types of the securities. What is contractual cash flow? It's nothing but the return. For different securities, the returns may be different, and that type of the return and how much return you are going to get. So those all things are mentioned in the contract itself. The principal value will change in case of the equity. So this is one type of the instrument according to the market fluctuations, where it is not the case of the debt instruments. The value of the debts are not going to change much. Likewise, return is dependent on the several factors in case of the shares. Okay. So if you are investing in the shares, then redemption option, leverage, return, everything will vary. Correct. So these all things are mentioned in the contract. When you are purchasing the instruments in that contract, these all things are mentioned. In case of the return, we need to consider the time value of the money too. We need to consider the inflation effect too. So this is the very important condition of the contractual cash flow characteristics. In short, we are going to call it as CCFC. Contractual cash flows reflects the inconsistent return with the basic lending arrangement. So inconsistent return. In case the return is directly related to the lending arrangements, if you are investing in any of the instruments, that means you are lending, you are providing the debt for the borrower, correct? So in the lending arrangement or the contract, if the return is directly related, then it is called inconsistent return, correct? So this is the main condition of the CCFC. So there are three types of the financial assets, mainly debt instruments. If you are invested in the debt instruments, okay, the securities what I told, debt securities. If you are invested in the equity instruments or equity securities, and if you are invested in the derivatives, if the derivatives are favorable, then we are treating it as financial asset as per the definition of the financial instrument. So here is the classification. The basis of the classifications or the criteria of the classifications are these two types. Business model. In short, we are calling it as DM, and contractual cash flow characteristics. Fine. So we can treat the financial assets in three ways. Financial assets we can carry it in fair value through profit or loss account, and we can carry the financial assets in the amortized cost, and we can carry the financial assets at the fair value through other comprehensive income. In which method we are following is also important. We need to measure the financial asset in the amortized cost if the below conditions are met. Here is the conditions. Financial asset is held with the business model. Hold the asset to collect the contractual cash flow. It's nothing but you are not going to sell the asset, and you are holding the asset, and you are going to wait for the returns. Okay. Rise in the cash flows on the specified date that are payment of the principal and interest on the remaining principal. It's nothing but partially selling. Okay, you're going to sell it partially, and for the remaining amount, you are going to receive the return. happens, then you are going to value your financial asset in the amortized cost. And if you are treating the financial asset in the fair value to other comprehensive income, you should fulfill the two conditions. The contract is held with the business model and collect the contractual cash flows and sell the asset. Sell the security in the market value after getting the return. Okay, so this is what mentioned here. Rise in the cash flows on the specified date that are payment of the principal and interest on the remaining principal. So this is also the third type. So you are going to sell the part of the securities when the market value is high, and for the remaining amount you are going to get the returns. Okay. Then equity instruments with the irrecoverable elections from the entity to carry at in the fair value through other comprehensive income. At the beginning of the contract, if it is mentioned in the contract to measure it in the fair value through other comprehensive income, then we don't have any options. It is irrecoverable. Correct? So then we need to mention it in the fair value through other comprehensive income only. So when we are going to treat it in the profit and loss account, fair value through profit and loss account, treat it in the FVTPL if these assets are not measured in other two types. If the asset is not measured in these two types, then directly we need to take it to the fair value through profit and loss account. At the initial recognition, asset found as irrecoverably designated to treat it as FVTPL. So at the beginning of the contract itself, if it is mentioned to treat the asset in the profit and loss account by fair value, then we need to treat it in the fair value through profit and loss account. Fine. So remember these short forms. Okay, these short forms are given here. Fair value through profit and loss account, fair value through other comprehensive income, and CCFC, contractual cash flow characteristics. Fine. So this is how we are going to treat the financial asset or measure the financial asset. So here is the classification of the debt instrument. There are three types of the instruments in the financial asset: investment in the debt securities, investment in the equity securities, and investment in the derivatives. Fine. So we are going to check how we are going to treat it. If the debt instruments conditions are fulfilled in the contractual cash flows characteristics test. Okay, what is the condition of the contractual cash flow characteristics test? The return what we are getting from that instrument is inconsistent of the contract of that particular instrument. Okay, so while we are purchasing, we are going to enter into a contract, and in that contract, if it is mentioned that the return is inconsistent, then we are going to check further, and if it is not fulfilled, then we need to treat it in the fair value through profit and loss account. If this particular condition is fulfilled, then we need to go for the business model test. In business model test, we have three options. Condition 1, healthy contract to receive the contractual cash flow. It's nothing but return. So we are going to hold the contract and waiting for the return. Right? If you are waiting for the return, then we need to treat it in the amortized cost. Condition 2, collecting the cash flows and selling the asset. So receiving the cash flows to and afterwards selling it, then we need to treat it in fair value through other comprehensive income with recycling. What is with recycling? Once you are sold that particular asset, again you are going to reinvest in some other type of the assets. Okay, maybe in the debt instruments itself or in the other type of the assets. If neither condition one, this one, and condition 2 is not fulfilled, we need to treat it in the fair value through profit or loss account. So this is about the debt instrument measurement. The classification of the equity instrument is bit simpler than the debt instrument. For the equity, contractual cash flow characteristic test will not apply. If we are holding that equity for trading, then we are going to treat it in the fair value through profit and loss account. If we are not holding it for the trading, then we have two options. If fair value through other comprehensive income is selected, obviously fair value through other comprehensive income measurement and no recycling. Okay. If fair value through comprehensive income is not selected, then we need to go for the fair value through profit and loss account. Fine. So this is about the equity instruments. The classification of the derivatives are measured only by the fair value through profit and loss account. So the derivatives classification is further simple. So we need to note that in case there is a changes in the business model, these all classifications of the debt instruments, equity instruments, and the derivative instruments will change. But the business model is going to change only in the rare occasions. So that's why I'm not going to focus on the reclassification. That's it for today's class. From next class, we are going to study the same classifications with problems.